Good morning, ladies and gentlemen. My name is Kristie, and I am a venture capital editor with DealStreetAsia. Thank you for joining us today. We have 3 Asian family offices here joining me on stage. All of them who are obviously experts in their fields. I just want to start off by asking them to perhaps give a very quick 2-minute intro, the background of your family office, as well as how long you guys have been in alternative investments. So maybe let's start with the furthest, Nydia. Yeah.
Sorry, this as the mic is need to adjust that for a bit. Hi everybody, my name is Nydia. I am the investment director at Ferretto Capital. So we are a single family office and we're a 3rd generation Thai family. So the family business is in hardware manufacturing. And as a SFO, we established ourselves around 3 years ago. So we kind of run as an endowment model. So we allocate about half liquid versus illiquid. And I look at alternative investment for the family office.
Hi everyone, I'm Kelly. I'm from an Indian-originated single-family office. We're based in Singapore, and we have been started since year 2015. Currently, we have a multi-asset portfolio, which we primarily have some private and non-private assets under the portfolio.
Good morning, everybody. My name is Lawrence Chu, and I run BlackPine, a family office based out of Hong Kong. We have been around since 2013 as an investment office. Our portfolio is half, I think, in traditional assets as well as traditional alternatives. The other half is a bit more active. We call new economy alternatives, very mission-driven, and we're very hands-on in that portfolio.
Okay, so, over the last few years, obviously we've seen a huge shift towards alternative investments, right? As of today, what proportion of your portfolio do you set aside to private capital as well as to alternative investments? And, how has that kind of shifted in recent times, especially in light of the events in 2022? Maybe, Nydia, do you want to start off first, and then we can just go down the line?
Yeah, sure. So as I just mentioned, we run a endowment model, and so I guess on the private side that we allocate to investments in all stages. So we have hedge fund exposures, private credits, venture capital, as we have our own VC arm that's based in the Bay Area in the United States. And then we also have an uncorrelated basket. We have investments including music royalties, litigation, life insurance buyout. And then we also do direct deals. But again, our approach is mainly allocated to fund managers.
Yeah, we do pretty much the same. That said, we do, over the years, have established a focus on life science, fintech, and property tech. So over the years, the valuation has been high. So at the moment, we're on 25% private market, where we approach opportunity by debt or equity. And then that 25% is only counted on the called capital. So we're still waiting for the deals coming along and work with the fund manager to keep doing this space.
For us, when we first started, it was more of an 80% in traditional and 20% in alternatives, where we're very active. And we have a very specific mission focus for our active portfolio. I think time-wise, it's flipped. So time-wise, we probably spend 80% of our time on our more active alternative strategy, and then less than 20% really of our time in the portfolio allocation. So mainly in the traditional side, yes, we invest in stocks, bonds, real estate, as well as a lot of funds. I think we're very comfortable with funds given my own personal background in the finance industry. But we do spend a lot more time in the new economy alternatives, which is pretty much a investment on people, I call it. So, and that slowly over the last 8-9 years has, from an asset perspective, also grown. We don't actually put new capital into that portfolio, so it has to recycle. But it's a very wide range of things that we do in that portfolio. So we look at what we call new economy alternatives, is really fields that are not necessarily commercial today, but we feel has societal impacts and really fits within our mission. And it's, again, backing people. We back small groups, fields that are a little bit left field for the time being. It doesn't have to be an investment. It could be a research grant. It could be a whole load of different things. But I think what's happened is that it tends to start off that way as direct investments or co-investments, and then slowly may evolve into either companies, funds. It could be LP commitments. So that's kind of how we operate.
And how is that fared, especially in light of, since the market correction in the beginning of this year, has your approach kind of evolved, especially, given your exposure in Web3, I believe. We were just talking off stage just now, a little bit about that. There have been a couple of developments, which I'm sure you guys are very well aware of, FTX. How have you guys been kind of monitoring the situation? Some top-line views on that?
So definitely, because the approach is recycle, a new deployment has been slower. But I wouldn't say that's completely zero, right? I mean, it really continues to evolve and develop. I think fortunately we do have good companies, and in the Web3 space, digital asset space, we've been involved since 2014. So that portfolio has grown, and there's a mix of, I think, what we would consider more liquid positions, as well as a very, very big, sizable allocation into private companies and privates and private equity, which is a bit more long duration. With that said, it's fine for that portfolio because it's not necessarily meant to be a liquid portfolio. So I think, when I'm sure my esteemed colleagues here will have the same portfolio allocation. Oftentimes, we're probably allocating a certain amount for liquid, working capital, yield, expenses, and that has to remain liquid. And it usually comes from our traditional fixed income side. We do have that also in certain parts of our new economy alternatives, and that's really been pervasive because of crypto and the liquidity profile of those type of investments. But otherwise, most of it is very, very long term. Like, the last 3 years, we've been focused on, for example, quantum computing, right? It's not anywhere near being commercially viable, right? There's maybe 1 in 100 companies which we think are, kind of in that sort of exit horizon. But most of them were like, okay, maybe 10 years from now, 20 years from now, but let's see how it develops. So it's a relatively longer term view.
Maybe for Kelly and Nydia, since we're talking about crypto, I mean, what is your exposure and your experience with crypto? I mean, when did you guys start? Up till now, the recent events that unfolded, do you think as family offices, your exposure, your interest in, a field that's still quite nascent actually, the level of exposure in that field, do you see yourself still continue to remain invested in that sector?
Yeah, we started the time at, I think, the same time as the whole crypto interest started in the investment world. As we always approach a portfolio, there is we keep it certain interest in the portfolio, which we call it more from a humanity point of view, like ESG, like unrepresented interest. We do think blockchain technology overall help those interests to solve the issue. It's just how we approach it. So we think it's technology itself and supporting technology and the business is also one element we should look at. But at the same time, we are very cautious. We're trying to think in terms of financial assets, in terms of how to do it, in terms of timeline, where should we exactly put it in our portfolio. So at the moment, under our portfolio, as we are purely work with fund managers. So in our portfolio, there are fund managers doing coin or blockchain technology related investment. And we work with them and trying to understand together as how we collaborate in the space and to bring our interest further. Yeah, I think.
Yeah, I think on our side, we currently do not have any blockchain crypto related investment. But with that said, we've been paying attention to the ecosystem for a while now. And I think just to comment on the current, the recent FTX, incident, I think it's really detrimental for the ecosystem. And then, sure, there is, concern about real use cases, applications for blockchain. But personally, I think the biggest concern is actually integrity. And I think the ecosystem, the community will take much longer time to rebuild. But I think for the underlying technology, there still is tremendous potential. But I think this, take this as a wake-up call for all the entrepreneurs and then, founders and everyone that integrity should always come first. And I guess on the investment side, we do pay attention for opportunities, for example, like price discrepancy, dislocation when it comes to cryptocurrency, that we will likely just treat them as, wonderful asset classes. So I guess, on funds that we're looking at, we're looking at some like cryptocurrency arbitrage funds, and then, so on that direction.
Next question is for all three of you. I mean, how do family offices like yourself approach due diligence, especially when we talk about highly nascent sectors like crypto that are still extremely new and still emerging, and particularly for investors say, like yourself that are more active in your portfolio? What is your approach and kind of thinking around doing due diligence today?
We have a slightly different setup. I think partially because my background is investing, so I have investment teams. But like the two ladies on stage, overall portfolio allocation is asset allocation, right? And we don't claim to be professionals and experts in everything. So we definitely rely on best-of-class managers and people who dedicate their lives and their teams to looking at certain sectors, particularly those that we feel definitely there are, tier one, very obvious, leaders in real estate, in private credit, in hedge funds, etc. On the more, nuanced side of things, I would say we do the same thing, except they're probably smaller teams, very specific. So, there are strategies that we deploy in, for example, alternative protein or artificial intelligence and machine learning or Web3. And these are really choosing teams who provide the same type of expertise. So some of the things that we may do more on our own side would be direct investment. So it's co-investing with all these managers. So in the last couple of years, we've been fortunate to have seeded or backed a number of, particularly in Web3, liquid strategies as well as venture strategies. And through that funnel, we have access to a lot of different direct opportunities. And that's where potentially my team can deploy some of our recycled capital. But at the end of the day, most of the stuff that we do is evaluating managers and people and teams who are the best in their field. And that's like a network that we've kind of developed over the last couple of years.
Yeah, I would totally agree with Lawrence. We take the same way as we work together with a fund manager. To be specific, as a family office, we from the beginning understand we're not a very well-oiled machine like institution per se. So we try to learn and try to bring out what we have. So we pretty much discipline ourselves. Given the background of us in real estate, hospitality, pharma, education, we try to focus especially on the private deal in an area we can contribute mutually with the fund manager and the industry. At the same time, we try to connect to more deals and the right communities like today, this event, and keep educate ourselves and learn from there.
I think for us that we are a third generation family office, and then because the family business is in quite traditional industry, so I think one thing is that the family members do understand cycles a lot because they've probably been through multiple cycles. And second is that I think they really value the importance of innovation. So with that said, we do allocate, and we like solutions for secular trends. So there are three, I would say, humanitarian crisis, so to speak, that we really are seeking solutions for. So we paying a lot of attention on aging population, labor shortage, and also climate change. So and then we understand that you definitely need patience, you need grit, and then you also need a lot of talent. So I think what that being said is that we definitely right now the financial outlook is bad globally, but that doesn't really stop us to allocate to, I would say, brilliant funds that are still very much committed to solving those problems.
We've seen a lot of VCs as well as PEs, particularly during the boom times 2020, 2021, where a lot of checks were getting signed, a lot of deals were being done these last 2 years. How much competition do you think these guys are presenting to someone like yourself, a family office, that is also looking into expanding your deal flow, your deal making in areas like tech, areas like VCs, exactly the same areas that these guys are looking to do as well?
I think for us, I would say family offices in general are partners, usually capital partners. On the non-tech side, I was having conversations with a big US shop about US buyouts, right? Mostly US buyouts, but global buyouts. And again, their role is they're not a buyout shop, they're actually a capital provider. But when a GP needs the extra resources to compete or to have certain regulatory or geographical or even subject matter expertise, then hopefully we can be a partner. I would definitely say we're not competition. It's not our job, right? We're not day-to-day focused on deal sourcing in the same sense. I think we will deal source from within our network, and I think that credibility comes from the GP's past performance and what they've been good at. So I guess from that point of view, we can pick and choose and select.
I mean, does it make it more difficult to kind of highlight your particular value add as a family office, especially? I mean, even venture capitalists these days, there's a whole variety of funds out there in the market. Some of them are becoming more and more sector focused. They have their own in-house teams, research teams to be able to do, DD into areas that are extremely niche and extremely deep tech, and all of these guys are also competing for the same types of deals that you guys are looking to do. How does this kind of, in terms of value add, how much competition does this kind of bring to family offices, and how do you kind of put yourself out in the market now? Has it changed?
Yeah, I think Nydia brought up two very good points. One is innovation, another is cycle. So for us, we understand we were also a risk owner, not just asset owner. Some people call us permanent, yeah, true, but also risk owner. To take this risk and make the return from that, we feel the value adding point is always about people. So in terms of timeline, perhaps we're more flexible. Perhaps that's through the whole learning journey, we can form some new views, way of doing things. I do see the change in a whole financial industry in terms of how people work after COVID. So I believe we as family office, we can offer things such as to be specific, like a nurturing, like an incubator, that kind of thing, to work together and spend more and more time over there.
Yeah, for us, because we mostly allocate to fund managers, and then I guess we do look at direct deals opportunities, and then in terms of how do we normally work with fund managers, I think first, we are capital contributors, right? That we place our trust in them via capital, but we do see that also because we mostly allocate to the US, and then as we still have an operating business that's based in Thailand, in Southeast Asia, so sometimes we do see that if we can bring in strategic value add, if there are, I guess, need for some of the companies even from those funds, especially, for example, we are looking at deals that does EV battery membrane, so that's very heavy on manufacturing distribution. So we are more than happy to come on the table and to share our 2 cents in terms of if a US company want to expand to the Asia region.
I think all three of you also have a pretty significant exposure to the US right now. First question is, and obviously all of three of you are also LPs in several funds. How do you find the funds in Asia Pacific in terms of the profile of fund managers, in terms of the quality of the investment pieces in Asia versus some of your US portfolio? Do you see yourselves kind of diversifying perhaps your exposure a little bit more this year? Because in my conversations, quite a number of them are looking to do that. Is that something that you guys are also looking to do? And what kind of fund managers, really interest you? Because I think we do have a number of them here in our audience.
I go first. Okay. I don't think we look at it that way. Geographically, yes, but I think globally now in most geographies and even in most subjects, I think we have very professional managers. Of course, there's definitely going to be more in the US. It's just a deeper market, longer history. So it depends on what you're looking for and where you're allocating your assets. Again, mid-cap buyouts, then definitely a little bit more US, Europe centric. Asia, Southeast Asia, very specific Southeast Asia geographic focus. Southeast Asia tech is another focus. Private credit across Asia, another focus area. You're not going to find necessarily a US manager that's going to be the best Asia private credit specialist. We're probably going to find someone here who has relationships, knows all the rules and regulations, probably started their career at a international professional kind of firm, and then I would say, the market has grown to an extent that there definitely are super professional managers based here that attract global capital as well. So. We're not allocating anything additional necessarily to the US from a geographic point of view. We're looking at it more, from a sector point of view, perhaps, and then, fine, the US, there's a new fund that provides that type of exposure, so we'll do that. I think that's kind of the way we approach it.
Any specific sectors that you're looking at?
I think in Asia, we've been looking at private credit. That's something that on the traditional side. On the tech side, we continue to deploy into deep technologies. So AI, ML, alternative protein, Web3. Those are the 3 main ones that we're knee deep. So want to continue to develop those. Yeah.
Kelly?
For us, on the private credit side, yes, also. And most of the fund managers are already global, so I need not to focus on anything. Then for other venture and private equity deals, our focus on life science, fintech, and property tech. I would say the interest in consumer are in Asia, and however the technology itself, the team, the nurturing, the environment, the build, the go-to-market is still in US and Europe. So we're pretty much here and there together to be from the beginning to later stage. So that's perhaps the part we can value add to take the opportunity from beginning and help it grow in a bigger space. Yeah, I think.
Yeah, for us, I think I've came to Singapore multiple times this year, and then I think the landscape in terms of, so I mostly talk to early stage like venture capital funds, so that's more of the demographic that I speak most to. I think it's definitely a different focus between Asia, and then you can even divide that into Southeast Asia, and then China, and then the US, right? I think maybe taking a step back, the first is to understand that which region has what advantage, and what angle are you trying to invest in. So, for example, if you look at Southeast Asia fund, that a lot of time they still want to do platform tech, essentially trying to implement what has worked in the West, and then to their own region. And then for China, it's a complex ecosystem, right? You are seeing things has evolved from the dot-com boom, and then to expand into like either 2C, 2B, and then so it really takes a lot of work to understand that where is the remaining opportunity. And then so for US, because we like mostly 2B and then deep tech focus, that we say that the US still have technology advantage, but it's also important to pay attention that not everything that works in the US will definitely work in Asia.
Quick question on China. What is your exposure to the Chinese market, and stepping into 2023? How do you, if you could have a crystal ball, how do you think things are going to shape up? And what does this mean for all of you as fund managers?
I think China, for us, we have been exiting since 2016, 17. Not because we're exiting China, it's just we had a really big exposure to China, which required us to be a bit more diversified geographically. But with that said, I think certain pockets...
Happened in 2016, 17.
2016, 17, yeah.
Why 2016?
We invested in a number of technology companies early that end up having relatively large exits. So for us, that was a reason why we decided to expand geographically, including Southeast Asia. So we entered Southeast Asia in 2016, 2017. As part of the portfolio, I would say in certain technologies, we don't do as much VC investing there. Biotech, we do. So we have a team that does just pure biotech, domestic China. Naturally have some real estate exposure. And definitely on the liquid side, we do. So in fact, this year, we have been reallocating back to China on the liquid side. So equities is the main focus. So we're not, afraid or, shying away from having China exposure. In fact, we think it's actually relatively good value. Okay. But maybe a little bit less on big tech and late stage VC for China's specific strategies.
Because obviously there's been a bit of a tech divide that has really widened, particularly this year. For fund managers like yourself, I guess that means that you might have to go into hyper-focus mode into very specific sectors that may work for someone like you, but may not work for someone else, perhaps.
I think for returns, it's quite policy-driven. So it's a bit more of our passive part of the book. And we have managers and partners who really know the market well. So we let them do that. Biotech, why? It's just mission-driven. It's less, of course, we want to generate returns over time, but it's less focus on, I need liquidity, I need a certain exit. It's just that we think, okay, good team, good people, good mission. It's like a little bit less onerous in terms of policy, headwinds, because I think it's something that the government wants to promote. But otherwise, I think on more general investing in China, it's quite policy specific. It's not rocket science. I think it's not like super hard to decipher. You just need to read it, understand it, and find a manager who can also interpret it in the right way. Everything is public, right? Essentially.
Kelly?
For China, we started the family office in 2015. China remained the tactical portfolio itself for us. The reason because we have a large exposure to India. So being tactical, we approached China by fixed income in 2016, 2017, 2018 for mid to short duration fixed income bond denominated USD. It was good. So then there was the V shape of China A shares and the general public stock. And so we were value the opportunity and trying to see what should we do and fund manager. Luckily, we shortlisted 3. It remained tactical also. We exited some of our position from China A last year. So in future, it still remains our tactical portfolio. But there's some, like Lawrence mentioned, I think the trigger point is we will find another fund manager that works, the strategy works, and geopolitical reasons more stable for us, especially of FX. I think that would be our decision point to move forward.
Yeah, China is an interesting topic. I would say look at it from different, from different perspectives, right? I think for venture capital, that is because the very nature of if you want to invest in a fund that is 5 years active environment period and then 10 years lockup, right? So that kind of puts you in the box that you kind of need to commit on a strategy for a long period of time. So on that front, that concern will be, well, political uncertainty and then sudden change of regulation and then geopolitical factors, right? But with that said, we do have colleagues that look at what you guys just mentioned, that if there will be more liquidity advantage, that we definitely are happy to take a look. But what I'm saying is that there is a double standard based on the liquidity preference when it comes to China.
It is.
Maybe last question for all 3 of you is how big is secondaries part of your portfolio strategy? And are there any interesting dislocations in the market, especially during this season, that you're seeing that could be an interesting opportunity for fund managers like yourself to kind of step in? So maybe you first, and then we go down.
On the secondary side, tech secondary, we've had actually more exits than new positions. But we're opportunistic. But at the same time, and this is probably a little bit more Asia-focused exits. But at the same time, we just recently committed to a global secondaries fund. So probably a good time to allocate to a manager who's specifically picking up not necessarily just direct positions, but also they do both direct positions as well as fund positions. Yeah.
For us, we do think there will be a revolution coming after the COVID, and in terms of valuation, do think we will restart actually overweight primary market first time since establish of the family office. So we look forward for the good fund managers to help us to go forward with that.
Yeah, we're definitely seeing, well, I think it's very obvious that right now it's a buyer's market, right? So on our side, we're actually seeing some very interesting opportunities. I think mostly on dislocation in terms of pricing. On the venture side, we are looking at, for example, we normally, as family office, even we do direct, we normally see A+. But we're the later the stage right now, the bigger the markdown, right? So we're seeing that you can invest in at the Series B valuation for Series C deal with great commercial tractions, with great founders and very strong business, and then I think because we very much focus on secular trends, so we are here for we're here for the long game. So on some level, it doesn't quite affect us in terms of the areas that we invest in, because we know in the next 5 to 10 years that the world will still need more crops. People still need to eat. And then there will be more and more older population that need medical care, that need places to live. And we are, like the earth is getting warmer and warmer by day. So that doesn't really impact it by, in the next 1 to 3 years, when we're in the midst of financial tsunamis. So I would say, it's easy to get emotional in the short term because we're all human beings, right? We're investors, and it's understandable. But I think sometimes it is important to take a step back and then evaluate your portfolio. Discipline is very important to understand that, okay, if it's in a certain basket that we are taking a long game, how much is actually impacting, the health of our portfolio.
I think with that, we have come to the end of the panel. Thank you, everyone.